John just inherited $1 million. He's in his 30s, has no dependents, no mortgage, and no burning desire to climb the corporate ladder. What he really wants is time. Time to travel, time to build something of his own, or maybe just breathe a little. And like many of us, his first thought is, well, what if I could live off the dividends? It sounds perfect. No boss, no meetings, just money showing up while you sleep. But the options, they're overwhelming. Some strategies are rock solid but pay very little. Others offer massive returns but come with serious risk. So John decides to test them all. In this video, we're going to walk through 7 different dividend strategies, starting with the safest and working our way up to the riskiest. We'll see what kind of income each one generates, and more importantly, what kind of life it actually supports. And in the end, I'll show you an asset that'll pay John $150,000 in yearly dividends right away. Let's start at the beginning with the most classic, conservative choice there is: the dividend-paying blue-chip stocks. John starts with the most familiar, least risky name he can think of: Coca-Cola. It's iconic, global, timeless, and when it comes to dividends, few companies are more respected. That's what John wants first, a solid foundation, something safe. So he puts his full $1 million into Coca-Cola stock. With a dividend yield sitting at 2.97%, that gives him $29,700 a year. That's about $2,475 every month just in passive income. On paper, that sounds pretty decent, but let's look closer. At $2,475 a month, John could probably cover rent in a small apartment. He could buy groceries, keep the lights on, maybe cover a basic phone and internet plan, but that's about it. No vacations, no car payments, no money for hobbies, health insurance, or savings. This kind of dividend income doesn't buy freedom, it buys just enough to get by, with the constant need to stay cautious. The upside, Coca-Cola isn't going anywhere. Its revenue is steady, global demand is strong, and the dividend is among the most reliable on Wall Street. The check shows up every quarter without drama. But John can feel it, that low-level financial tension. There's no slack in the system, no margin for mistakes. One big bill, one health emergency, and things could spiral fast. And that's the irony. He's technically living off dividends, but barely living. This strategy is like using your $1 million to build a small, strong house with no windows. It's solid, but you can't see much of the world. You're protected, but you're not really free. John doesn't regret the test run, though. It gave him a baseline. Now he's wondering, what happens if I give up a little bit of safety for a little more room to breathe? Let's find out. After seeing what Coca-Cola could do, John doesn't want to jump straight into riskier waters, not yet. Instead, he looks for a step up in yield, but still within the world of safety. That's when he lands on Johnson & Johnson. It's a dividend king, a company that's increased its dividend for over 60 consecutive years. It operates in healthcare, consumer products, and pharmaceuticals. The current dividend yield for J&J is about 3.11%. So what happens when John invests his $1 million into J&J? Now his annual dividend income bumps up to $31,100, about $2,592 per month. That's a slight increase, only about $117 more per month compared to Coca-Cola, but it feels like something. A little more flexibility, a little more room to think. With $2,592 a month, John could afford a slightly nicer apartment, maybe a better neighborhood. He could pick up a small health insurance plan, maybe save a couple $100 a month instead of watching his balance flatline. But the core reality hasn't changed much. He's still budgeting every dollar, still living in survival mode with just a better mattress and maybe one takeout meal a week. The dividend is rock solid, and if safety is your number one priority, it's hard to beat. J&J has been through lawsuits, market crashes, industry shakeups, and the dividend just keeps climbing. But now John is starting to think in bigger terms. He's not just trying to not work, he's trying to live, do more, have more time and flexibility. He realizes that even ultra-reliable companies can only do so much, especially when the yields are modest. So, what if he stops picking individual stocks altogether and lets an entire portfolio of reliable companies do the work for him? Time to test out a different approach. John's getting the hang of this. After trying 2 individual stocks, he starts wondering, what if I let a basket of strong dividend companies do the work for me? That's where SCHD comes in, the Schwab U.S. Dividend Equity ETF. It's a dividend-focused ETF made up of companies with strong fundamentals, consistent dividend history, and solid cash flow. Think of it like getting a professionally curated playlist of top dividend payers without having to pick each stock yourself. SCHD's current yield is about 3.82%. John puts his entire million into SCHD, and with 3.82%, he's earning about $38,200 per year, or roughly $3,183 per month. Now we're getting somewhere. That's enough to cover all the essentials: rent, groceries, utilities, insurance, and still have some wiggle room. John can keep his car maintained, take the occasional weekend trip, maybe even treat himself to a new computer, a nice dinner once in a while, or even start contributing to a retirement account again. No more penny pinching, no more walking on financial eggshells. What's more, the ETF structure gives him built-in diversification. He's not relying on one company. If one business cuts its dividend, the others help smooth things out. It's a less emotional ride. But it's not total freedom. John still has to watch expenses, and there's not quite enough to feel totally comfortable if something goes sideways. A medical bill or a home repair could still derail things. And while 3.82% is much better than 2.97%, it still caps his income below the national median salary. So John's not disappointed. In fact, this is the first strategy that makes him feel almost independent, but the key word is almost. And now that he's seen what a little more yield can do, he wonders what's next. What if he leaned into a specific sector that's known for even higher dividends? He sets his sights on energy. Energy companies often throw off serious cash, and many return that cash to investors through generous dividends. The sector is cyclical, yes, but it's also built into everything: transportation, manufacturing, even electricity. John finds an ETF called USAI, the Pacer American Energy Independence ETF. It invests in U.S.-based energy infrastructure, including pipelines and natural gas companies, businesses that generate predictable contract-based cash flow. In USAI's case, the dividend yield comes in around 4.32%. So John decides to give it a shot. He puts in the full $1 million, and just like that, he's earning about $43,200 per year, or $3,600 every single month. This is a great start, a solid return from a dependable stock. But as we move up the ladder, both in risk and reward, things start to get a lot more interesting. I'm going to show you investments that pay even more, and in the end, I'll show you an asset that'll pay John $150,000 in yearly dividends right away. Back to USAI and $3,600 in monthly income. That's enough to live alone comfortably in most U.S. cities, cover all bills, keep a decent health insurance plan, and still save or invest a few $100s every month. He could afford weekend trips, upgrade some tech, eat out more often, and support a modest hobby, maybe photography, music, or design. His lifestyle is no longer survival-focused, it's flexible. But here's the catch. Energy is unpredictable. Geopolitics, oil prices, regulation, any of these can swing the sector. If earnings drop, so do dividends. And unlike broad ETFs, sector-specific ones don't always offer a cushion if one segment takes a hit. So while USAI gives John the best quality of life so far, it also introduces more uncertainty. Still, for the first time, John feels like he's actually in control. If he wanted to, he could cut back to part-time or even take a long break from work altogether. Sure, the road might get a little bumpy along the way, but with this kind of income coming in each month, it finally feels possible. But something's still bugging John. If a 4.32% yield from pipelines can give him this much ease, What if he could get this kind of cash flow, but from something even more consistent, like rent? When most people hear the word rent, they immediately think of real estate. And yeah, so does John, but not the kind that comes with clogged toilets, noisy neighbors, or late-night repair calls. He's not looking to be anyone's landlord. He wants real estate that pays without the headaches. That's when he discovers Realty Income, ticker symbol O, also known as the Monthly Dividend Company. It's a REIT, a real estate investment trust, which basically means it owns things like retail buildings, medical offices, and warehouses, and rents them out to businesses on long-term leases. And because REITs are legally required to pay out 90% of their profits to shareholders, they're known for having some of the highest and most consistent dividend yields around. In Realty Income's case, that yield sits at around 5.68%. John moves his entire million into O, and just like that, he's earning $56,800 a year. That's nearly $4,733 per month. This is the first time things feel complete. With this income, John can live comfortably in most cities. He can pay for rent, utilities, groceries, insurance, car expenses, and still have room for travel, hobbies, and savings. He's no longer tiptoeing around every financial decision. He could comfortably stop working altogether or work part-time doing something meaningful. He could even consider starting a project he cares about, like a YouTube channel or a small e-commerce shop, purely for passion, not pressure. The best part, Realty Income has monthly payouts. That regular cash flow mimics a paycheck, making it feel more stable and manageable than quarterly dividends. But there are risks. REITs are sensitive to interest rates. If borrowing costs rise, property values can drop, and so can share prices. And while Realty Income is considered one of the safest REITs out there, it's still a sector-specific play, meaning if retail or commercial space hits trouble, income could dip. Still, John sees this as a major milestone. This is the first time it feels like dividends could actually support a real lifestyle, not just survival. But after seeing what a 5.68% yield could do, John starts wondering, what if I go just a little further up the yield curve? That leads him to a surprising pick, UPS, United Parcel Service. Yeah, the delivery giant with the big brown trucks. Not exactly what most people think of when they hear high dividend stock, but after a recent dividend bump, UPS is offering a yield of around 7.52%, and that catches John's attention. It's still a massive, well-established company with global operations and steady demand, but now it's paying more than some of the riskiest names out there. So John runs the math. $1 million in UPS would generate $75,200 per year. That's $6,267 a month. Well, that changes everything. Now we're in lifestyle territory. He could rent a bigger place, travel more often, treat himself without guilt, and even fund a creative side project like writing a book or building an app he's always talked about. He could help out family, support a charity, or just enjoy life without budgeting every penny. For the first time, the income isn't just covering life, it's creating space for joy, for freedom, for new possibilities. But this isn't a free ride. The shipping industry is cyclical. Economic slowdowns hurt volume, labor negotiations, fuel costs, and automation pressure margins. Not to mention a high dividend means a high payout ratio, which makes it vulnerable to cuts if cash flow dips. John realizes this isn't like Coca-Cola or Johnson & Johnson. This is a company that could surprise you in either direction. Still, the appeal is strong. With $75,000 a year, he could live well, build something, or do nothing at all, and do it without watching every penny. And now, he's asking the question anyone else would ask at this point. What if I took this even further? Not 7%, not 8%. What if he went all in on something yielding 15%? It's bold, it's risky, but maybe it's the final step toward full-on freedom. John has seen what 7.5% can do, but what happens when you double that? That's when he comes across AGNC Investment Corp., a mortgage REIT that offers a dividend yield of around 15%. At first glance, it almost feels too good to be true, and in some ways it is. AGNC makes its money by investing in mortgage-backed securities, and while those can be stable and calm markets, they're also incredibly sensitive to things like interest rates, borrowing costs, and housing trends. When things go well, it's great, but when the tide turns, those big payouts, they can vanish fast. Still, John is curious, what would it look like if he leaned in completely? With $1 million invested in AGNC, he'd be bringing in a massive $150,000 a year, or $12,500 every single month. And now, with that income, the possibilities are endless. He could live anywhere in the world, take multiple international trips, support his family, and invest in anything he cares about. He could take 5 years off if he wanted. He could live stress-free if the income lasts. And that is a big if. Mortgage REITs like AGNC are notoriously unstable. Their dividends fluctuate, their share prices can drop sharply in a bad year. And while 15% sounds like magic, it's also the yield of desperation, a payout that may not be sustainable in the long term. John knows this. He reads the warnings. He sees the risks. And yet, the possibility lingers. This is the only strategy that would give him everything he wants right now. Complete freedom, but with a ticking clock. So the real question here isn't, can I live off this? It's how long can I count on it? For John, that uncertainty outweighs the temptation, and it leads to a deeper realization. Freedom doesn't come from chasing the biggest number. It comes from finding a number that you can rely on and live with. So these numbers are incredible, no doubt. But not everyone has $1 million to start with. There's actually an even easier way to reach a reasonable goal. Click the video on the screen to find out how to make $7,000 per month with only $20 a week.